Hi everybody, this is Gary dealing with Sentiment Timing, and this is our technical video report for Thursday, August 8th, 2019. So very strong day for the markets today. From what I'm gathering, it's kind of crazy because the strength is because of the chaos going on in China that the Fed is going to go back to cutting rates again. It's insane. But anyway, it was a strong day across the board. That there is no uh, sugarcoating that one. But it also was kind of anticipated. This was I had mentioned when we came up and we came down when we were coming down here. If you remember in the morning notes that I had put out, I had said it don't get overly bearish, because if we took these lows out here and we most likely were going to come down somewhere into the 2793 level, we were going to get bullish divergences, and then from there we were going to anticipate a stronger rally. So here we came down, we kind of made a double bottom, and here's the very strong rally. So the zone that I was looking at, I had said that this was the short-term bull bear line, 2910. You can see once we got across that, we did see some momentum pick up. Now, what's happening is we're actually running into the next resistance zone. So we have the 2950. I've been saying this for since we were down here. I believe that we were going to come back up somewhere into the 2950. Now, I would say where the bears lose 100% control of this drop is this zone right here, going through the 2963 up to the 2977. You could even go 2984 because that's a 78% retracement from this high to this low. So I'm just going to even move this up here and say here, this is the line in the sand. If the bulls get above this, then we're most likely going to take out these highs and make another, a new all-time high. So this is where the bears really need to step in this area right here. I had said that this was the initial target because we had the open gap. Now we also have an open gap that's at the 29.49. So this was my reasoning on why we were going to come up to these levels here, because the bears are very neat. They don't like leaving open gaps, and this would be the area they anticipated move. So we're running into it right now. I leave the door open that we could get up to the 2984. I do believe this area is going to be some heavy resistance. You can see we already have bearish divergences on the 15-minute charts. As a matter of fact, we're making new highs. If I kind of zoom in a little bit here, if you take a look at the MACD histogram here, as well as with the new highs here, it's negative. So typically when we see something like that happen, it's usually not a good sign right here, where you can see we're negative on momentum, but we're making new highs. So this is a massive divergence right here. Doesn't mean we have to turn tomorrow. No, just because we know that when the bulls get any kind of momentum going, if they're not held down, they're going to keep going with it. So the fact that they're running off of, things are so bad between us and China that the Fed is back into cutting rates again. I mean, I just personally think it's nonsense. But in any case, this is what it is, and you have to take what what the market is thinking right now, and that is pretty much exactly what they're thinking. So if we head higher, again, I'm looking at the 29.49. That would be the next short-term target. And then above that, we're going to look at the 29.64 and just leave the door open for the 29.84. Now, with these bearish divergences and momentum like that, if they're going to get up to these levels, they're going to gap above it. It's just that's the way the bulls have been working. But this move overall, is pretty solid. We had this gap right here, but overall, it's a solid move. So let's take a look at the 60-minute chart here. You can see they still have some gas in the tank before we get into the extreme overbought levels. But also notice we don't have any bearish divergences here. So this is leaving the door open, and it fits the profile that Woody had laid out for what he was expecting strength into, for this to be taken out. Now, if it does get taken out, what we have to, what this is really what's going to be looking like right here. I do believe that if we lose the 200-day moving average and this the 2800, that we're going to get a very very fast move down to this this low right here, the 2725. Now I put this as a possible head and shoulders pattern. This is not part of that plan right here. This has to come down further, because this would not really look like a shoulder if we came up and then came down again. It's just not there. You can see the way the shoulders kind of take a little time to build. So we're right at we closed right at the 50-day moving average. We have bearish divergences. We're nowhere near in oversold levels. So this would be an area that we could see, if it does turn down, it would actually have a lot of bulls kind of wondering what is going on, because the 200-day held, and if the 50-day holds and then we take it down, it's going to actually give the bears some pretty good momentum, because the 50-day was used as resistance, and then if they take out the 200-day, that support is gone. But I still believe that if we come down, I'm anticipating that we would see some buyers step in somewhere around that 2735 level, and then if that happens, what I'd be looking for is a bounce back up to pretty much where we are right now, anywhere between the 2956 to where we close today. And then that would set up the right shoulder for a possible bearish head and shoulders. Now, it's very early in it. I don't know if this is the pattern that's in play, and this is the big reverse symmetrical triangle pattern that I've been showing you. And if this kicks in, I mean, it's looking for a target below below the lows that we made in December. So it's a crazy pattern, because here you have the bulls that everybody is looking for the moon and going straight up, to where the bears are looking for a crash, and then we come back up again, and the bulls are back up to looking for a move to the moon. Then we come back down, and the bears are back in crash mode again, and we're back up again. So the pattern is looking for it, and it's in play. It's just one of those things. I'm not sure if it's going to play out or not, but this is it. And really, the first thing that the bears have to do is get it through this, through the 200-day moving average, and then really the panic line will be below the 2728. So again, right now there's a little more room. There's gas in the tank if the bulls want to head higher. We have obviously we're at the 50-day moving average on the daily, and we have the 200-day moving average that's at 2951. That's also this gap, and it's also some price resistance. If they get above that, then we got to keep an eye on the really important bull bear zone, and that's going from the 2966 up to the 2981. Above this, I think the bears, they lost it, and we're probably coming up and taking out these highs. Now, what do the bears have to do? First thing, I could even move this down, and I know it's very elementary technical analysis, moving averages, but there's times that this is what the market follows, and it is. So right now we're looking at the first thing the bears have to do is, well, let's just say the first thing is get it through to 29.19, because that is some support here. But really, more importantly, I think to get some momentum going is below the 29.08. If they do that, this would be the next stop, the 28.86, and I think it's really important, because if they lose this, then we're coming back down to the 28.48. And honestly, we've already tested this bottom twice. If we come down to these levels, I believe it's going to be taken out. And then from there, that's where we anticipate the move coming someplace down to the 27.93. And if things get, really bear ugly and momentum really picks up on the downside, then we're looking down at the 27.28 level. So let's take a look at the Russell right here. It's a pattern. It's one of the indexes that I've been showing you, because this thing topped all the way back in almost a year ago, September, August 30th. 2018, and you can see that we're way below those. So this is considered the risk index, and I've been really kind of pounding it as far as a indicator for the overall markets. But I'm gonna kind of throw you a little bit of a curveball here, because the overall pattern does not look all that bearish, meaning it looks like we're in a triangle. And if you just look at where the fib levels are, we're consolidating up here after a big move up. So it's one of those things that if anybody wanted to kind of do a hedge trade, I kind of think that you can try long the Russell 2000 and then short the S&P. And really what you would be looking at is that if they both go up together, the Russell's going to go up higher than the S&P. Now, again, this isn't a trade recommendation. It's just one of the things that this is a risk index, and when it does gain momentum, it moves very, very fast. So if you're looking to kind of hedge a short, you can go long the Russell and simply just put a stop below the 147. It's a little bit of a spread, but if it gets above these moving averages right here at the 150, I'm sorry, the 1546, I believe we're coming back up, and it could be a very quick move up to the 1621. So again, it just could be some type of hedge if you're interested. But before you even go there, I want to show you one other thing, and this is that the fractal pattern of the VIX. And I'm sorry this video is really long, but I had a lot I wanted to go over. So remember what I was looking at on this: 1, 2, 3, 4, and then a spike up 5. So here is our 1, 2, 3, 4. It kind of delayed a little bit like it did here, and then this was our a spike up 5. So now let's go into what's next. Now we're coming down into the wave 6 here, which we're in this area here. And the next thing should be wave 7 that pops up and tests the where we made the highs on the 5. So that would be up at the 24, 25 level. So it's close to a 50% gain. So this is why I'm saying we're in a trading environment right now, because you just look at what the VIX is doing, and this is where the chaos is. So if this holds true, the next move should be somewhere up into the 7. And if you notice, this pattern did do what it was expected. So I think really if you take out the if you see the VIX take out the 1471, then I don't think we're getting a wave 7 up, because I would say that's a pretty good say line in the sand. So, but anyway, so this is actually looking for a spike higher. And again, if we just take a look at where the S&P is right at the 50-day moving average, it is something that you want to keep an eye on. So again, that if we do head higher, I believe that we're probably going to come someplace up into the 2951 level. If the bulls really start to catch momentum, you got to keep an eye on the 2984 and the 2966. Bears, they really need to push it through to 2906, but more importantly to 2883. So with that, I will be getting the morning notes out really early tomorrow. I'm in a golf outing, and I have to be out of my house by 7 o'clock. So I'll be checking out what the futures are doing, but if there's any news that's going to push them, unfortunately, I won't be around to follow up with it. So with that, have a great weekend, and I will talk to you guys on Monday.